Hi everyone, and welcome to today's session. We've got a lot of ground to cover, including how to know your retirement number, how to structure your wealth for maximum tax efficiency, and how to build an investment portfolio that's truly retirement ready. I'm Cameron Smith, founder of Benson's Wealth. For over 3 decades, I've had the privilege of helping Australians plan for retirement, grow and preserve their wealth, and make confident decisions about their money. Now more than ever, we're seeing people enter retirement without a real plan, and that's risky. The wrong moves in these years can cost hundreds of thousands of dollars over your lifetime. The right move can mean more income, less tax, and greater peace of mind. We're living longer. Markets are volatile, and for many, the financial landscape is more complex than it's ever been. So if you're over 50, approaching retirement, maybe already even there, and you want to make smarter, more confident decisions with your wealth, this presentation is for you. In today's session, we're going to walk through a framework we've developed over decades, helping many families and individuals prepare, structure, and invest with confidence. We'll cover the three core pillars of a confident retirement, including knowing your capital number, i.e., how much you actually need. Two, structuring your assets wisely for safety and best tax outcomes. And number three, investing with the right strategy for where you are in life. We'll also walk you through some of the most costly mistakes we see and the common misconceptions that can trip up even the smartest investors. Just to quickly share who we are, Benson's is an independently owned private wealth firm. We help our clients plan for retirement, build and protect their wealth, and invest their money. And we've been helping our clients for over 35 years, some clients of which are still with us from when I started the business all those years ago. Now, just a bit of quick housekeeping before we dive in. This session is being recorded, so you'll be able to come back to it later. Feel free to jot down any questions as we go. We'll do our best to address the most common ones at the end. The strategies we'll discuss today are general in nature, but I'll do my best to show how they apply to different situations. This isn't personal advice and doesn't take into account your exact situation or circumstances. Now, this session is all about education and insight, and my hope is that you'll walk away with a clearer understanding of what's possible and how to make smart, structured decisions with your wealth. Let's get into it. So I want to start with what we see most often. For many Australians over 50, there's a lingering sense of uncertainty. Will I have enough to retire? When can I afford to stop working or at least make work optional? Am I invested the right way? Is my super working hard enough? What about if I run out of money too soon or miss the chance to enjoy life now? These are great questions, but they're often met with guesswork, vague advice, or no real plan at all. And when there's no plan, it can create both emotional and financial stress. People aren't sure how much they need. They don't have clarity on how their money will last or how long their money will last. And many are unaware of how taxes, inflation, poor investments, or even just timing can undo decades of hard work. Today, we're retiring earlier, living longer, spending more in retirement, and often want to leave something to our children or grandchildren. But the world around us has changed. The cost of living is higher. Super balances often aren't enough to fund income for 30 years. And the age pension, if you're eligible, is harder to rely on, with fewer taxpayers to fund it and rising government debt. We've seen people take the DIY route or follow advice from someone not really equipped for this phase of life. And it's cost them dearly. Missed opportunities in super, paying far more tax than necessary, holding portfolios that don't deliver income, or staying in cash out of fear, which quietly erodes wealth through inflation. And often the biggest mistake is people delaying taking action. They wait for the perfect time. But we find clarity doesn't come from waiting, it comes from planning. Retirement isn't just about stopping work, it's about being financially independent, with the freedom to live on your terms, backed by a clear strategy. That's why we use the three pillars I mentioned earlier: knowing your number, structuring your assets wisely, and investing with confidence. So let's get into the nitty gritty. If I could give you just one insight today, it's this: the single most important number in your retirement plan is not your age, it's your capital number, the amount of money you'll need, invested the right way, to live the life you want. Most people never actually calculate it. They just hope what they've saved will be enough. And hope is not a strategy. When you don't know your number, you risk two very big mistakes. One, you stop working too soon and run the risk of running out. Or two, you work far longer than you needed to and give away years you could have spent doing the things you love. The first pillar is about making sure neither of those happen to you. Lifestyle before numbers. Before we get to the maths, you've got to get to the heart of it. What exactly do you want retirement to look like for you? You can't calculate your number until you know what kind of life you want to live. Before you jump into the spreadsheets, first we start with vision, the actual lifestyle you want. I'm not talking in vague, do what makes you happy. I'm talking specifics. Where will you live? Will there be a downsize, an upgrade, a sea change, or even a tree change? Will travel be a part of it? Just once in a while, or are you the overseas twice a year couple? Are you the kind of person who wants to eat out 3 times a week? Will you help out your kids or grandkids financially? Maybe pay for some education, help with a home deposit? Is there a hobby or passion you want to finally invest time and money into? Sailing, photography, volunteering? With our clients, we often set two lifestyle income targets. Firstly, we have a baseline income, the minimum that you'd be happy living on. This covers all necessities and some comforts. Or secondly, we have an ideal lifestyle income, the full wish list version of your retirement. For example, your base might be $100,000 a year. The ideal might be $150,000 to $200,000 a year. Neither is right or wrong. There's only your number. Now, there are some income guidelines you can use, and they're published by a body called ASFA, the Association of Superannuation Funds of Australia. According to ASFA, a comfortable retirement for a couple requires about $690,000 in assets, and that will provide an income of $73,000 per year. And for singles, it's about $595,000 in assets, generating $52,000 per year of income. For some, those ASFA numbers are fine, but for many of our clients, especially those who want active travel years and a comfortable lifestyle, they need a higher target. I've seen couples happily live on $50,000 a year. I've also seen couples spend $300K a year and not think it's excessive. The point is, the ASFA number likely isn't your number. When can work become optional? There's also another important question beyond when can I retire? And that's when can work become optional? For some people, work is part of their identity. They don't want to stop cold turkey. They just want the freedom to choose. That freedom comes when you've hit your capital number, the number that you know can sustain the income you desire for the rest of your life. Some target a date, retire at 60. Others target a number. Once I have 2 million invested, I'm done. Either approach works as long as it's planned. Here's a question we always ask. Do you want to spend down your capital over your lifetime or maintain it so it's there for the kids, charities, or just a safety net? Depleting capital means you draw on both income and principal. This can give you higher spending power in the early years, but requires very careful management so you don't run out. Then there's maintaining capital. This means you live mostly or only off the income your assets generate, keeping the principal largely intact. This is more conservative and often means lower spending capacity early on. Example, $1 million earning 7% equals $70,000 a year of income. If you spend $100,000 a year, your capital reduces. If you spend $70,000 a year, your capital is largely preserved. Again, neither is right or wrong, but it changes the size of the number that you need. One of the biggest myths in retirement planning is that your spending is the same every year. We find that that's not true. Most of our clients follow a spending curve that looks like this, a smile curve. There's the active phase, which is generally in the early retirement. There's travel, dining, hobbies, family gifts, and spending is higher here. There's the passive phase, mid-retirement. You've ticked off some bucket list items, travel slows down, and lifestyle spending often falls. Then there's the support phase, in the latter years. There's healthcare and aged care costs, and sometimes these rise significantly. Planning for this curve and making sure the early years are as full as you want them to be without compromising later years is one of the most important parts of financial planning. The beauty of financial planning and retirement is that you have so many choices and levers that you can pull. Using calculators and modeling what these choices look like can give you a real sense of what's possible. Do you want to retire earlier? Well, you probably can, but you might need to downsize the home sooner, invest more aggressively, or be more modest with travel expenses. But it is possible. Or maybe you want to spend more in early retirement. Well, then you may need to work a few extra years, sell an investment property to liquidate capital, or increase your portfolio risk to generate a higher return. The reality is, you can have anything you want. You just can't have everything you want. The earlier you start making those choices, the more flexibility you have. Let me introduce David and Marianne. They were both 62. David wanted to keep working until 67 just to be safe. He'd heard they needed at least 3 million to retire. Here's what they actually had. They had 1.6 million in super, investment outside super of $700,000. They had their home paid off, and their spending target was about $140,000 per year. So we modeled two scenarios. Scenario A, keep working to 67, end up with 3.2 million at age 90. And scenario B, retire now, end up with 1.2 mil at age 90. Both scenarios fully funded their lifestyle without running out. The difference, 5 more years of freedom, 5 more years of travel while healthy, 5 more years with grandchildren. David looked at Marianne and said, why would I work 5 more years for money we'll never spend? Common mistakes to avoid. Now, there are a few traps we do see over and over. No forecasting or modeling. Making decisions based on gut feel and no data. Underestimating inflation. Your 100K lifestyle today could cost $150,000 in 15 years. Over reliance on one asset, e.g., I'll just sell my home, and ignoring sequencing risk. Big early losses can permanently damage your plan. Key takeaways. Knowing your number changes everything. It's not about getting the biggest number possible. It's about designing your life first, then building the capital to support it. When you have clarity, every decision gets easier. When to retire, how to invest, whether to sell a property, whether you can take the big trip next year. That's why we start every plan here with pillar one, knowing your number. All right, say you know your retirement number and timeline. The next question is, where is that money going to come from? And equally important, how is it structured so you keep more of it in your pocket instead of handing it to the tax department? Most people focus on the investment returns, but the truth is two people can earn the exact same return yet end up with very different retirement outcomes purely because of how their money is structured. Structure affects the tax you pay, the flexibility you have, the longevity of your assets, and even what you leave behind for your family. In this pillar, we're going to cover the four main buckets your wealth can sit in, how they're taxed, and the strategies that can transform your position before and during retirement. So there are four main tax buckets in Australia: superannuation, personal investments held in your name, companies, and trusts. Each one has different tax rules, different access rules, and different implications for how long your money lasts. Understanding these and using them deliberately can make a bigger difference to your retirement than chasing the next hot investment. Let's look at the tax on each bucket. There's super, accumulation phase. This is where most people's super sits while they're working. Earnings are taxed at just 15%. There's super pension phase. This is the magic zone. Once you meet certain conditions, your earnings are taxed at 0% and the income you draw is also completely tax-free. Personal. Here, you're paying your marginal tax rate and from 0% to 47%. Company. Companies pay between 25 and 30%, but remember, if you take that money out personally, more tax usually applies. Trust structure. Flexible, but income must be distributed to individuals. So again, it's taxed at their marginal tax rates, anywhere from 0 to 47%. So here's the key point. The exact same investment could produce a very different after-tax return depending on which bucket it's in. And that means a different retirement outcome. Let's put some numbers behind this. So imagine you have $1 million invested, earning 7% per year. So that's $70,000 of income. In super accumulation phase, you pay 15% tax on that income. So you keep $59,500. In your personal name, at the top tax rate, you pay 47% tax. So you keep just $37,100. That's a difference of $22,400 every single year without changing the investment at all. And in superannuation pension phase, there is zero tax. You keep the full $70,000. That's $32,900 more in your pocket every year compared to holding it personally at the top tax rate. Over 20 years without compounding, that's an extra $658,000. Add compounding to that mix and the gap is enormous. This is why structure matters so much. The market doesn't have to work any harder. You just stop giving away unnecessary tax. So, what actually is super? Super is probably the most misunderstood structure in the country. When we ask people what super is, most say, it's my investment for retirement. And whilst there's truth to that, that's not quite right. Super is not an investment. It's a tax structure, a bucket that holds investments. The government created super because they'd rather Australians fund their own retirement than rely on the age pension. To make it attractive, they offer a very generous tax concession, which is why there are limits on how much you can actually put in each year. Inside super, You can own the exact same assets you could hold in your own name: shares, property, bonds, cash. The difference is the tax rate. In super, it's 15% or even 0% in retirement. Outside of super, it could be up to 47%. That's why I call it the most underutilized free kick in the Australian tax system. Here's the visual difference. Accumulation phase, 15% tax on earnings. Pension phase, 0% tax on earnings, 0% on withdrawals after 60. That's why our strategy for many clients is to deliberately move more wealth into super before they retire, because it gives you more income for longer without having to take more investment risk. So how do you get more into super? Especially in those final working years where your income and your ability to contribute is often at its peak. This is where contribution strategies come in. First, concessional contributions. At the time of this recording, the cap is $30,000 per person per year. These contributions are taxed at 15% inside super instead of your marginal tax rate, and they can be made from salary sacrifice or personal savings. For high income earners, this is one of the easiest ways to cut your tax bill while boosting your retirement savings. Second, catch up concessional contributions. If your total super balance is under $500,000, you can use up to 5 years worth of unused concessional caps, the $30,000 per year we just discussed. You still receive a full tax deduction for these. That's potentially a very large tax effective lump sum into superannuation. Perfect if you've sold an asset, had a high income year, or are in the final years before retirement. Third, non-concessional contributions. These come from after-tax money. You can put in $120,000 a year or use the bring forward rule to put in $360,000 in one contribution. Once inside super, that money earns income tax-free in retirement. This is especially powerful for people with large amounts sitting in personal investments where they're paying significant tax each year. Fourth, downsides of contributions. If you sell your home, you can contribute $300,000 each to super. You must be 55 or older and have lived in the home. It's on top of your other caps, meaning you can combine it with other contribution strategies in the same year, even on top of the bring forward $360,000. This is more technical, but incredibly valuable in the right scenario. By withdrawing from super and recontributing as a non-concessional amount, you can change the tax components inside your balance. The benefit: if your adult children inherit your super, they may pay far less tax. Now, when it comes to contributions, you do need to be mindful of your total super balance, or TSB. Is the total value of all your super accounts on 30 June each year. It determines whether you can make certain contributions, use the bring forward rule, or access catch-up concessional contributions. Transfer balance cap / pension limits. There's also a cap on how much you can move into the tax-free pension phase, currently $2 million per person. Anything above this stays in accumulation phase and continues to be taxed at 15%. And if you're aged 67 to 74, you generally need to meet the work test, which is working at least 40 hours over 30 consecutive days to make certain contributions. Let me show you a real example of contribution structuring. We work with a couple in their late 50s who had about 5 million invested personally, earning around 5% per year. Their annual tax bill was close to over $70,000 per year. Here's what we did. In June, each contributed $120,000 as a non-concessional contribution. in the same month, they each made maximum catch-up concessional contributions, as both had less than $500,000 in superannuation. In July, we used the bring forward rule to contribute $360,000 each. They also made a $30,000 concessional contribution in July each, and in just a few months, they moved over $1 million in total into superannuation. The result? Their tax bill that year dropped to almost zero. Once in pension phase, that 1 million will now earn income completely tax-free, adding around $80,000 a year to their net retirement income without taking any extra investment risk. And importantly, their personal investments are now much smaller, so their ongoing tax bill is lower, and we will continue to migrate money into the superannuation structure for them in the future. A few common mistakes that we see: drawing from the wrong bucket first, leaving large balances outside super when they could be earning tax-free inside, missing contribution opportunities, especially before age 75, overcomplicating structures without a clear purpose, not using those final 5 to 10 years before retirement to strategically shift money into super. So, once you know your number and your timeline, structuring your wealth the right way means you're not just relying on market returns to do the heavy lifting. You're using the tax system to work for you, not against you, which can be the difference between having enough and or falling short. Pillar 3, building the right investment portfolio. Now, we've defined your capital number, we've structured it for tax efficiency and protection. The next big question is, how do you actually invest that money so it works for you, not against you? And this is where most people make their biggest mistakes. The reality is, your investment portfolio is the engine that's going to power your retirement. One of the first things we ask new clients is, what are you invested in? Most can tell me their super fund name, maybe their risk profile, but here's the thing, that doesn't actually tell you much at all. If I put 500 so-called balanced funds side by side, all with roughly the same asset allocation on paper, you'd expect them to deliver roughly the same results, right? Well, the spread between the top quartile and bottom quartile performers has been as much as 4 to 5% per year. Think about that. Two people, same balance profile, same market, same time frame. One earns 9% per annum and the other earns 5% per annum. On a 1 million portfolio over 10 years, that's a difference between about 2.37 million and 1.63 million. Same risk profile, vastly different outcome. The gap can be the difference between your plan succeeding or failing. This is why one size fits all portfolios, especially the default ones in super, are so dangerous for retirees. They're built for the average member, not for you. And here's the truth. You don't need the highest return. You need the right return, delivered the right way for your needs. Because if you're chasing the highest return, you're often also taking on risk that can blow up your plan at the wrong time. In fact, I'd say most portfolios we see are not retirement ready. They might be fine for someone in their 30s or 40s building wealth, but they're often too volatile, too illiquid, or not set up to deliver a sustainable, tax effective income for 20 to 30 years in retirement. So let's step back for a moment and talk about the core principles of building the right portfolio for this stage of life. Beat inflation. If your portfolio doesn't outpace inflation, you're going backwards. Turn market returns into wealth, not just paper gains, but cash flow you can spend without eating into your capital too quickly. Stay disciplined. Markets will test you. Emotional investing kills returns. Diversify wisely, not just across shares and bonds, but across geographies, sectors, and income sources. Match the strategy to your plan. Portfolio design should be driven by your capital number, your lifestyle, your tax position, and your legacy goals. Now, there's three things to balance when it comes to your portfolio: growth, income, and capital protection. Growth assets like shares and property help you keep pace with and beat inflation. These are designed to grow your capital over the long term. Imagine owning an investment property. The growth is the value of the property increasing. Income assets like bonds, credit, and infrastructure provide stability and cash flow. These produce regular and repeatable income for the portfolio. Taking the same investment property example, the income is like receiving weekly rent. We want your portfolio to do the same. Capital protection comes from having defensive positions, cash buffers, shorter term fixed interest, and certain alternative strategies so you can weather downturns without selling growth assets at the wrong time. All this really means is making sure you hold investments that won't go belly up, where you don't lose your capital. Getting the balance right across those depends entirely on your stage of life and retirement goals, and is so important. This is where many people misunderstand risk. Most think risk is about how much the value moves up and down, volatility. In our view, risk is the chance of permanent capital loss, which means you permanently lose value in your investments. And in retirement, that usually happens when you're forced to sell investments at a bad time, typically after a big market fall, to meet your living expenses. Which leads us to one of the most critical retirement risks. Sequencing risk is the danger of poor investment returns early in retirement, when you're starting to draw income from your portfolio. Imagine two identical retirees, each with 1 million, both need $70,000 a year to live on. If the market falls 30% in the first year and one of them has to sell assets to fund their income, they're locking in that loss. Their portfolio has dropped from 1 million to 700,000. So they need to sell more of their portfolio to receive the $70,000 per annum. Their capital has taken a hit, and they now have less working for them when markets recover. That's why we use a bucket strategy. Bucket 1, cash, 1 to 2 years of living expenses in cash or term deposits. Bucket 2, income, assets designed to generate reliable income, dividends, interest, to refill bucket 1. Bucket 3, growth, shares and other growth assets for long-term capital appreciation. With a bucket strategy, your income in the short term comes from cash and income assets, so you're not forced to sell growth assets in a downturn. Investment property versus shares. I'm not anti-property, but I am anti the idea that property always outperforms. There's strong belief property is safer because it's tangible. But let's unpack that. We need to account for lots of different things like stamp duty, maintenance costs, insurance, cancel rates, agent fees, land tax, and income tax if held personally. You can't sell the garage if you need to access some money, and that's what we would call an illiquid investment. Property can be amazing generally when you are happy to actively manage it and when you use debt as leverage. That is, using the bank's money, not yours. In retirement, many people prefer access, liquidity, and ease, no tenant headaches, and regular income. And a well-diversified portfolio should generate around 7 or 8% every year. That's $70,000 or $80,000 a year of income. And if you need $20,000 for a holiday, well, you can access that too. Now, I know the usual response to the property versus share argument is how volatile share markets are. We've all seen scary news headlines. Markets plunge, biggest fall since the GFC. Recession fears hit investors. In March 2020, the ASX 200, which is the top 200 companies in Australia by size, fell over 30% in a matter of weeks. Many people panicked and sold, locking in their losses. Yet by the end of 21, markets had not only recovered, they'd hit new highs. Great investing isn't about reacting to headlines. It's about having a plan, sticking to it, and letting discipline, not emotion, drive your decisions. So, say a wealth manager puts together a portfolio for you. What do you pay them for? Well, it's not just about picking the best fund every year. You're paying for a strategy tailored to your plan, risk management that protects you from the big mistakes, structure that makes your portfolio tax effective, performance oversight, making sure your capital is actually working, and peace of mind, knowing someone is across every detail so you can focus on living your life, not on share markets. In most large super funds, your money is pooled with thousands of others. You have no say in the underlying investments. There's no focus on your personal income needs. And when markets fall and members withdraw funds, they often have to sell assets to meet redemptions, whether it's a good time or not. A bespoke portfolio gives you flexibility to adjust allocations, manage your withdrawals, and design for income in a way pooled funds simply can't. We had a client with a 2.2 million portfolio who had moved 40% into cash after a bad market dip, paralyzed by fear. Their portfolio was no longer capable of meeting their long-term goals. By redesigning their strategy into a bucket framework, we rebuilt confidence, reintroduced growth assets in a measured way, and ensured their income needs were met without touching the growth bucket in downturns. That's the difference between a portfolio that's safe today and one that's safe for the next 30 years. Common mistakes in retirement portfolios: holding too much cash, losing purchasing power to inflation, blind trust in default super portfolios, thinking it's just about returns without considering risk and income, ignoring sequencing risk. Great investing isn't about picking the next big thing. It's about protecting and providing for your life so you can live the way you want for as long as you want. So when it comes to building the right investment portfolio, it's not about chasing the highest returns or picking the next hot stock. It's about creating a portfolio that will protect and provide for your life for as long as you need it to. Which brings us to the final part of today's session: how we help clients take these concepts and turn them into a clear, actionable plan. How we help at Benson's Wealth. Our role is to take the three pillars we've covered today: knowing your capital number and retirement timeline, structuring it for tax efficiency and protection, and building a retirement-ready investment portfolio, and apply them directly to your situation. No generic templates, no guesswork, and no off-the-shelf portfolio. We've been doing this for over 35 years, working with thousands of Australians to help them move from uncertainty to clarity, and from hoping they'll have enough to knowing they will. Here's how our process works: discovery and clarity. We start by understanding your life, your values, your priorities, your family, and your financial picture. Then we map it into a clear model showing where you are today, where you're headed based on your current approach, and how that changes with strategic adjustments. Strategy and design. This is where we combine retirement modeling, tax strategy, structuring, and portfolio design. The result is a bespoke plan that's both achievable and sustainable, and one that gives you the income you need without taking unnecessary risks. Implementation and management. We implement the strategy with precision, putting your capital into the right buckets, the right investments, and the right structures. And we actively manage it, making adjustments as markets, tax laws, and your life circumstances change. Ongoing partnership. We're not just building a portfolio, we're building a 20 to 30-year relationship. You'll always know exactly where you stand, and we'll always be one step ahead of the big decisions. Our fees. We charge an engagement fee for the initial modelling, strategy, and engagement. We then charge an ongoing advice and portfolio management fee once we implement your plan. We are 100% fee for service, no investment commissions, and no exit fees. Every recommendation we make is in your best interest. Now, you might be wondering, will the fee affect my returns? The truth is, for some people, there's little to no benefit in engaging us or any advisor. But for others, especially those with complex situations, significant assets, or high retirement aspirations, the value we create is immense, both financially and in terms of peace of mind. We work best with individuals and families with $500,000 to $5 million in investable assets, those approaching retirement or already retired who want a structured plan, or people who value professional advice and a long-term relationship, and clients who want their wealth actively managed with strategic tax and estate planning built in. We're not a good fit if you're looking for stocks, tips, or speculative bets, the cheapest possible option without strategic oversight, and or a set and forget approach with no engagement. Why some firms charge less or more? In our industry, fees vary widely. Cheaper firms often offer more generic solutions, limited modelling, little to no tax or estate planning, and portfolios that look the same for every client. You may not work with an advisor in the capacity as a wealth partner, and they may not be there for the journey with you, only when you call and ask for an update. More expensive firms sometimes operate in ultra-exclusive niches with multi-layered service teams and higher overheads. We find that most of the time, this level of service is over-engineered and not required. We sit in the middle, offering a bespoke, high-touch, strategic service with full transparency at a level that represents strong value relative to the outcomes we deliver. What this looks like in real life is not just about returns. It's about things like targeting strong returns and protecting against unnecessary risk, increasing income, reducing tax, helping you spend with confidence through financial modeling, and advising on asset sales and capital events, handling the administration so you can focus on living your life. So when you look at our fees in the context of these outcomes, stronger returns and lower risk, higher income and lower tax, all the administration done for you, and most importantly, a partner that can guide you on making the right decisions and not the wrong ones, it's clear the real value is not just in investment performance. It's in having a partner who ensures your wealth works harder, lasts longer, and supports the life that you want to live. Let me give you a comprehensive example. A couple in their 60s came to us with 1.9 million across super, cash, and shares. They weren't sure if they could retire. and their portfolio was overly conservative, about 40% in cash. We restructured their assets into more tax effective buckets. We maximised their super contributions before and after 30 June, and we shifted their portfolio to a bucket strategy that separated growth assets from their retirement income. The result, their modelling went from running out of money at age 77 to funding their lifestyle confidently to age 94 without taking more risk than they were comfortable with. That's the impact of getting all three pillars right. The questions you should be asking any advisor: how much can I safely spend without running out? How do we avoid selling assets at the wrong time? What's the most tax smart way to structure my drawdowns? How will you protect my income during market stress? How will you collaborate with my accountant and update the plan as life changes? If an advisor can't answer those clearly, I suggest you keep looking. Before we wrap up, I want to cover some of the most common questions we hear from people in your position. I already have a super fund. Do I really need to change anything? Possibly not, but most default portfolios are designed for the masses. They often lack true income focus, can force asset sales in downturns, and aren't tailored to your exact tax situation or capital needs. What if I already have an advisor? Great. Good advice is valuable. Many clients come to us for a second opinion or for retirement specific work: capital modelling, tax structuring into pension phase, sequencing risk management, estate planning. If your plan is already excellent, we'll say so. If there are gaps, we'll show you precisely where and why. My accountant handles this. Do I still need advice? Accountants are crucial partners. They optimise what has happened. Our work is forward-looking, modelling cash flows, retirement timing, contribution windows, drawdown order, investment design, and family outcomes. The best results happen when your advisor and accountant collaborate. Should I start an SMSF? Sometimes SMSFs offer control and flexibility, but they're not automatically better. We look at balance size, complexity, desired assets, and appetite for trustee responsibility. Many clients achieve excellent outcomes in high quality platforms without SMSF admin. Have I left it too late? We hear this a lot. The 5 years before and after retirement are the most powerful years for change. Contribution strategy, moving assets into pension phase, tightening portfolio design, removing unnecessary tax drag. You're not late. Do I have enough to work with you? We work with a wide range of clients, but most have between $1 and $5 million in assets, some with 500,000, some with 5 million. We have advisors who specialize in different things. The key is whether you want a clear professional strategy for the next 20 to 30 years. If what we've covered today resonates, if you'd like to know your own capital number, the most tax-effective way to structure it, and the right portfolio to make it last, we offer a complimentary strategy session. In that session, we'll map your current position and project your retirement timeline, identify the biggest risks to your plan and how to mitigate them, show where structuring and portfolio changes could extend your retirement income by years or even decades, and outline a clear action path forward. There's no obligation and no pressure, but most people tell us it's the most clarity they've ever had on their financial future. To book, simply click on the link below. You've worked too hard to leave the next 20, 30 years to chance, whether you work with us or not. Get clear on your number, your structure, and your strategy, because that's what will determine whether your retirement is lived with confidence or with uncertainty. What it includes: a short phone call to confirm we're the right fit. If suitable, a one-on-one consultation. How to book. There's a button on the screen. Apply for your retirement strategy session. We review each application to ensure we can genuinely add value. We only onboard a handful of new clients each month to protect our service quality. So if clarity would help you,